Let's roll. I was going to use, that video of Nancy Pelosi where she comes out and says, I would say good morning, but it certainly isn't a good morning, or whatever she says. That was my line. But,
What's that from?
Just when she was sad one time. Yeah. And she walked into the press conference. She was like, I would say good morning, but it certainly isn't one. It's just funny. But I won't use that line anyway. I will say good morning. Welcome to another episode of Momentum Mondays. It is March. It is not March. It is April 7th, 2025. I have to really look because the dates are just, it's hard to keep up with. Older you get, I guess. Anyway, we had a very interesting week in the markets last week. I'll let you kind of do a wrap up of the, what do we call it? The fine print. And then we'll jump into it. But the whole point, we're going to talk about tariffs. We're going to talk about, the market.
Do we
have
have
to talk about some updates in the portfolios for our clients?
Do we have to talk about
I think we do. Yeah. That's kind of one of the linchpins of this show. But go ahead with the disclosures and we'll attack it.
Yes, as always, a quick reminder, the information on this show is for informational purposes only. It's not intended to act as investment advice, so consult a financial advisor you trust, or go to momentumwealth.us, schedule a complimentary consultation. Be more than happy to talk to you about your situation. But always do so before making any decisions based on today's discussion, or quite frankly, anyone's discussion that you listen to. Your situation is unique, and there's a lot more subtlety and nuance that goes into crafting an investment plan for your specific situation than just what is on the headline news or headline financial news.
Yep, that's good. So last week in the markets was extremely volatile. We kind of knew it was going to be with everything that was going on last week.
Today is volatile if you have not been made aware.
Yeah, today is volatile too. We had overnight, we can talk about that certainly, but we had overnight, when the market opens up for futures, it was down quite a bit, and then the market is open now. It's kind of popped back up.
It's back down.
It's back down?
Yes, but the Russell 2000 is up, even though it was down.
Well, the Russell 2000 is lagged, so it could not. There's a lag there on that indicator as far as when you're looking at performance.
Okay.
But yeah, let me pull this up because my app is not working for some reason. So we have the week of 3/31. We've got the S&P down 9.07%, the NASDAQ down 9.87%. NASDAQ actually reaching technical bear territory, which is down 20%. Last week, I think it reached that on Friday. Dow down 7.8, Russell 2000 down 9.61. If we take a look at our commodities, this is extremely interesting. Gold down 1.53, silver down 12.65. If you remember, our whole conversation has revolved around gold and silver outperforming the market year to date. That's still the case, funnily enough. Yeah. But silver took a I don't even know what you call it. I mean, they took a dump on Friday.
Yeah, it did. And that's because of, as we've said on this show countless times, industrial demand generally is going to drive silver prices. It's very volatile, though, and that's why we don't use silver as part of our precious metal, our risk managed precious metals allocation. And we use gold for that portion of the portfolio. But silver is very volatile, but it is very interesting to see what is happening in the commodities index. We have copper is down. We have oil and gas. I don't know where you were going with this, but we have oil.
Well, the 10-year bond is next. That's
10-year. Let's do the 10-year
last year. Last week, 1.87%. The Bitcoin was actually up half a point. It was flat, really.
For the week.
We would consider that to be the week. So if we look at what that did to the year-to-date returns, S&P down 13.5%, the NASDAQ down 17.2%, Dow Jones 9.5%, and Russell 2000 17.8%. And then looking at the commodities and metals, Bitcoin up 15.5%, silver up 2.85%, 10-year bond up 5.4%, and Bitcoin down 15.5%. So that's kind of where we are with our indexes. Volatility is going to be probably, I would say, the theme of the coming weeks. We've got some updates we'll talk about with our sort of portfolios that we manage here in-house at Momentum Wealth for clients. But it's a lot of uncertainty, and I think that's the theme now is uncertainty. And so people are really not sure. The other interesting aspect of it is that retail buyers, meaning not institutional buyers, not big money managers, these are retail buyers, they bought the absolute most that they have bought since like in 10 years. On Thursday and Friday, there were giant buys from retail investors.
And that's amazing because that time period obviously includes COVID and the COVID stimuluses, which had a lot of market mania as a result, really the beginning of 2021 when that last stimulus package came through.
Yeah, but that's a really good point, though, that I really hadn't thought about until you just said that.
More people bought,
which is that
a
lot of people saw their coworkers and relatives maybe buying, and that worked out in that instance, and they're not going to miss that opportunity again. The question is it going to be the same sort of V-shaped recovery that we saw? You know, that bear market, I think we looked at it, was only like 40-something days.
45 days.
45 days. So if we have another, we're not really in technical bear market anymore. We're pulled out of that. But it's, I don't know how technically I'm sure they still consider it a bear.
I think your average retail doesn't, if they just see it's down.
Right.
It's down. And this is their opportunity to own, you know, especially if, let's say, if they've been online, they didn't spend a lot of time on Reddit or perusing, seeking alpha. You know, they may be itching to get some NVIDIA, to get some Tesla, to get some Apple, to get some of the Mag 7 because they're like, oh, wow, now I can actually get in at a lower price and maybe I can actually double or triple. That may be driving a lot of that. But I think that JP Morgan's note on being the largest influx of retail dollars in a single day in a decade is, we could fact check us, but I bet it's just purely on the indices.
Yeah, I don't know. That's interesting. I didn't see exactly where it was. It was just the volume of buying. And I don't even know if that information is available or if they're just taking in the whole,
just aggregating
net
all
purchases.
Of the buy side.
Yeah. The whole buy side.
That's very interesting. And that was not a 401k buy day either because it was Thursday. So it wasn't a Friday for paychecks. And that's interesting. We have wages have gone up now consistently since the beginning of the year. Spending's down. That could be filtering through into more purchases going into the 401k balances. It's always a possibility, you know. But volatility, excitement. That's the word I've used since the beginning of the year. There's going to be excitement. That doesn't necessarily mean up or down. It's just as much as it's the movements in either direction are going to be occurring, and we are seeing that. We have the trade tensions that are bubbling up as a result of Liberation Day tariffs. And it's got people on all sides of the equation, whether that is inflation, short-term economic slowdown, all the reflation trades may be kicking in, lots of sector rotation occurring. I just really honestly, the way you look at this market, I think that nobody really has a good handle. If you're a short-term trader, they really don't have a good handle on what's occurring, because I would hate to be on a strong, non-data driven short sell, on a strong short sell in a market like this where one tweet can flip it. That's a dangerous place to be if you're trading on margin, especially. But on the inflation side, and I was thinking about this over the weekend, we know that the Fed is not going to consider a step change in prices inflationary. And I think the market writ large agrees with that, because we brought up the topic of minimum wages and how minimum wages can create a step change in input prices, but that does not necessarily denote a trend. It's just simply a step change. So that aside, if we look at oil and what has happened in the last week with oil, CPI data is reported over a rolling 12-month period, meaning that when they report in April, it will be for March compared to March of last year. When they report in May, et cetera, it'll be April for last year. From this time 12 months ago, oil is down almost 30%.
Yeah.
So that's going to be very interesting to see how that feeds into the inflation data. That does take time. Same thing with housing. That's taken a long time to, if we look at the Trueflation, which is very interesting data, it's private sector data. It's not the government CPI, but they do a pretty good job of spotting the trend, both on the up and the down. It's been settling around 1.3. So that would lead me, the Fed would probably catch up. The CPI, the government numbers would probably catch up to that in about 12 to 18 months, if that is the case. But just oil going down 30% year over year, that's going to put some significant deflationary pressure on the CPI.
Yeah, and also make pretty much everything writ large
Cheaper.
because of transportation costs.
Yeah.
But, I guess the whole idea, and we don't, we usually have show notes here that we kind of go through. We kind of talk about that occasionally. We don't really have many today because I just want it we want it to be a conversation about what are the possibilities that are going on with the tariffs and the tariff conversation. And so it's very different, and we've talked to a lot of people about this that have called in. It's very different from the first Trump administration where he might threaten tariffs when the market closes one day, but before the market opens the next day, he's already called them off or said they're going to be delayed or had a negotiation or whatever. Now we're seeing the tariffs sort of stick around, and he's not really in any hurry, and his cabinet is kind of echoing that same sentiment that they're not in any hurry to, make any kind of moves that would sort of calm the market. It's really interesting that the market was actually up today at open. It's back down now. And some of the names that we were looking at earlier before the show are back down as well.
That could be indicative of a further rotation. It could be, it's possible that it could be a local bottom signal. But I wouldn't expect any, and really as a long-term investor, none of this really matters to you.
Right.
At the end of the day. But if you're interested in these things and you like to digest the data and the news, and it's something that's enjoyable for you to do, and it gives you a higher degree of confidence in your own personal investing, I would not be looking for really a light at the end of the tunnel. Probably for I'd say 6 to 8 weeks. That would be my guess. I think that it's possible, and Jay, you mentioned over the weekend, J.P. Morgan is talking about the Fed cutting much sooner than people thought. On Thursday, you were talking about that it's, you can pretty much take it to the bank that you're going to see the Federal Reserve move to cut interest rates, which a lot of people had really wanted them to do anyway.
Trump included.
Yeah. Every president wants lower interest rates. This is just a common theme. Every president wants to have low rates.
I think it's particularly timely at this point because everybody knows that the debt has exploded. Government spending has exploded. And so there are certain things that have to happen because you can't have every single bit of the revenue coming in going out to debt service.
Yeah.
It's a problem.
It
would be on a household
mathematical
level.
Certainty that will happen if rates don't get lower.
Yeah, it's a problem at a household level with people, individuals, families. It's certainly an issue at the government level. And so what they don't want to do is have to come in and say, we're going to raise taxes. That's what he doesn't want to do. And so, I think that's where the tariff conversation comes into play. Now, is it going to work? I don't know. There are a lot of ways that countries can get around tariffs by having free trade agreements. You can have barriers to entry within those countries. Let's take, for example, Israel, who has enormous import taxes and VATs on top of that. So you can't, if you're an Israeli citizen or if you're in Israel, you cannot import a vehicle. You can, but you're going to pay like twice the cost of the vehicle. Those are not tariffs technically. It's sort of a semantic difference. They're not tariffs because technically Israel and the U.S. have a free trade agreement, but they are perfectly acceptable under the World Trade Organization rules because they are applied equally to domestic and imported goods. And so you can't have vehicles, and a lot of that is infrastructure. There's not a lot of roads, that they don't want a lot of cars over there in Israel. I get that, understand it. But that's an example of a country saying we have no tariffs, we have free trade with the U.S., but there's still a significant barrier to having U.S. products imported into those countries. And so there are ways around this where these countries, when you see the headlines, them saying we're coming hat in hand, we're going to get rid of our tariffs, that's only one piece of it. But they also have to make sure that they lower the barrier to entry for people to import the products, or it doesn't matter.
Yes. Yeah, just
because you're still not going to buy, the biggest thing are like vehicles, auto manufacturers, and furnitures. With people that create that kind of stuff in the U.S. cannot typically sell that overseas because of the cost of doing that.
Yes.
And so once that is removed, does that become more of a possibility for exports from America to hit these other countries that have thus far, not done that?
I just sent you an article that just popped up echoing exactly what you said here. Peter Navarro says Vietnam 0% tariff offer is not enough. It's the non-tariff cheating that matters. Literally just.
And it's just going to, I think this is going to be a bigger deal, and this is going to start to come up more and more in the news, is this idea of domestic taxes or domestic fees from these other countries that are not technically tariffs, but semantically they are the same.
Yes.
And so you can say that I have 0 tariffs on the U.S., but it also costs you two times the amount of whatever product you're bringing in to actually bring the product in. So you're not going to do that. So it's just a de facto way to still stall trade. And so there's a lot of, we're seeing the EU kind of capitulate, say they want to come to the table. We're seeing, the prime minister over there, I think, is the one that had initially said basically globalization as we know it is dead. But it's an interesting thing because I don't know where I fall on it really. I could see the need for allowing America, the U.S., to come to the table in trade, international trade, which we haven't really been a lot. I mean, we export a lot of soybeans to China, but, we're not exporting a ton of goods. I mean, you guys ran a business that experienced this where you were shipping products and goods to different countries, and
it's impossible. It's virtually impossible to sell into the European Union. It is virtually impossible to do it. In fact, we had contracts with a buyer in Belgium that ran some companies in France, and that lasted for maybe a year until they received enough of our product to be able to send it to somebody in the Ukraine to copy it and to sell it within the EU because they couldn't pay the VAT. It was just so expensive. And it's until you go through that and you see how somebody can make the exact same product in Europe, which has a higher standard of living than most countries, than most economic zones, and take that product, ship it across the exact same ocean, and then sell it to us, and the reverse doesn't occur.
Right.
And then to China, you can forget.
Right.
You can forget doing that with China. And in fact, what most people know to be a fact is that if you want to be able to retail products that you design, you have to go to China and use the cheap labor. But then what do? They're going to copy all of your IP. They're going to create a exact same copy. It's going to end up on Temu. It's going to end up in Harbor Freight or on Amazon, and you're done.
Yeah.
And this is just a fact. And yes, we ran a manufacturing company for about 8 years, higher end children's products, and it is the way the system has ran for 30 to 40 years. It does not favor American manufacturing. It just absolutely doesn't. And that's just the way that it is. I wish it wasn't that way. And it is changing, but here's the deal, is that how is that change going to be? Is it smooth? Is it volatile? These are the things that we don't know. And as market observers, we just have to take the data.
I don't think there's a world in which it's smooth. I mean, I think there are many parts to the conversation about bringing manufacturing back to the U.S. Do I think it needs to happen? Absolutely. I think we should make things here that we certainly have the ability and resources to make.
Did we forget COVID? Did we forget what it was like to not be able to get anything?
Yeah.
Even the medicines and the PPE that we made none of.
Yeah.
These things, they fade quickly into memory. So I think
that's what I was saying.
It's going to be interesting.
That's what I was saying last week. I don't know if I said it on this podcast, but we certainly talked about it internally, which is that I get it. That's the whole idea. I get it. I get what the point is. I get what is going on. But the question that I have is timing. Like, is this something that has to happen now? Or is this something that they could get everything situated and figured out? Let's really truthfully say that inflation is not going to rear its head back, because as of now, there's no way really you can say that. You can pontificate, you can speculate on it. Let's get past kind of this sort of stuff, and then let's tackle that. And so I don't know. I mean, there's a lot of people smarter than I am that are making these decisions. Scott Bessent is not a stupid guy. Howard Lutnick is not a stupid guy. I mean, these guys are smart, and there's really an argument to be made that Scott Bessent is looking. If you look at what Scott Bessent did before he was in government, he was a macro guy, and so he had he came to fame with Druckenmiller and looking at the European collapse basically, And so he's looking, his goal, what I've read, is to do the opposite of that in this country, make sure that doesn't happen. So he knows what to look for. So that's my question. I don't know. I mean, I just don't know why it has to be done now. That's my only question. It's an interesting conversation to have, and I don't know that anybody really doesn't think we should make things in this country. I'd love to meet you if you don't think we should make things in this country, but I think globalization to some degree is all right. But the U.S.
Well, I think traditionally
needs to be able to participate in it.
The intellectual pie in the sky. I don't mean that in a derogatory way, but the
North Star.
Yeah, it's like, okay, we want globalization, and we want to be able to extract value from specialization. So if you're a country that by happenstance that where you're placed on the planet, with the trade routes, with access to resources, with a specialized labor force, that country can extract value from that on the global stage. But that's not what's been happening. What's been happening is a mixture of other countries being protectionist, and that's what's so interesting. They'll say, well, protectionism is bad. Well, why has it been bad for the European Union? I know why we did it that way. I know to rebuild Europe and to have them as the front lines against the Soviets, we allowed, them to sell us whatever they wanted, and, they protected their industries from ours. I get that. The world has changed. The world has moved on. But, there is, I don't even know really where I was going with it, but there's really, specialization is not really occurring. What's happening is barriers to entry to trade, where things are not on the level. And then, of course, we can't ignore the fact that the Chinese Communist Party, has enslaved millions upon millions of people and used them as forced labor in order to cheapen the products to allow them to compete on the world stage. And, that is something that my view on that goes way, way back. I remember in 2011 or 2012 watching the Netflix documentary. I was loud. The Netflix documentary called Death by China. And it was done with some celebrity A-listers and Peter Navarro. And now we look at him having...
Ironic.
Yeah, and now he's involved in all of this. It's interesting. And like you said, there are people that are way smarter than all of us sitting here and all of us listening. That could give you a million reasons why or why not. But as investors, we look at the lay of the land, and we have to make decisions based on the data that we have available. And so let's talk about a lot of the data dumps that we got over the weekend, how that changed the tactical portions of our portfolio, and what does that mean for new investors? What does that mean for people that are just coming into the market for whatever reason?
Yeah, I mean, we have indicators that we look at that tell us basically how to trade and what to trade, what sectors we want to be exposed to, what sectors we may not necessarily want to be exposed to, how maximum our exposure to the equity market should be, and how little our exposure to the equity market should be. So we had an indicator that was in sort of watch mode all last week, and at the close of Friday, it flipped from positive to negative. And so for us, that meant that we are going to be raising a portion of cash today on the markets. Some of it, it's already happening as we speak, but we're going to be raising cash, and it's not necessarily about going to the sidelines. It's about sort of waiting for a better opportunity. That's what we really want to stress. We still have some exposure to equities. We still have some exposure to gold, Bitcoin, fixed income. Our types of fixed income have sort of shifted to take advantage of things like the lowering 10-year yield. But by and large, we're going to take a portion of cash to the sidelines, and it's going to be different based on every account, based on what your risk tolerance is, how much cash you'll have in your account. And then we will take that opportunity to wait for a better time to deploy that cash when our indicators are telling us that it's a better time. So when the fundamentals of the market start to improve and stop deteriorating, everything we do here is focused around momentum. That's why we call it momentum wealth management. So thus far, momentum has been to the upside. We think that it's, in your raging bull market, your positive movement of prices is going to go upward. So at a certain point, that starts to shift. So that now the most likely scenario is that the momentum is going to be to the downside. And our data is showing that that's what we're in right now. So again, going back to the COVID conversation, talking about the bear market there lasting 40 some odd days, this could be very similar to that. It also could not be very similar to that. There's just no way to know because again, a lot of the things and the indicators and technical pieces that we've looked at for months now, there's just so conflicting. And that's what we talked about last week. It's just conflicting data everywhere because you have sentiment indicators. You have retail investors buying hand over fist. You have volatility indexes that should be maybe based on where we are a little higher than they are. They're not moving, which doesn't really scream panic to me. Or
the credit markets are fine so far.
That's right. Well, credit markets have now basically given the Federal Reserve permission to cut rates. I mean, I saw that headline this morning. So it's going to be interesting. But our main point is for our clients for sure, but anybody listening too, this doesn't mean stop contributing to your accounts. This doesn't mean if you have excess cash, don't put it in the account. That doesn't mean any of that. That's still a great strategy for long-term investing, which is majority of what we do is long-term investing. If you're 5 years or lower, you don't need to be in the market at all. But we are going to raise some cash. We're going to go we're going to de-risk a little bit so that we can continue to watch the market and continue to watch what it does and then find possibly a better entry point. And that's the only thing.
Yeah. And that's having a tactical portion of your portfolio allows the ability to limit downside risk during periods of market volatility, but also the preservation of capital so that as there's a new market regime that appears after the end of this volatility, you can take advantage of that.
Right.
And so, when you're working with advisors that manage clients' money in-house, that make these decisions, these are things that you want to see so that, again, it builds you a higher degree of confidence and it also positions you for market outperformance, which is always the potential and it's always the goal when you're working with an advisor is to have less volatility with greater upside potential than you otherwise would have. And that is what we strive to do every day. Now, obviously, no one is going to guarantee that. There's no crystal ball. If they do, they won't put it in writing and it's never going to happen. So, you want somebody who's intellectually honest with you that says, listen, this is the process that we have to reduce downside volatility and also to increase return potential based upon the metrics that we have been working on here for years and years and years through multiple downturns, through the COVID downturn, through what happened with the interest rates going up in 2022. We've cut our teeth on volatility like this, and our portfolios are designed specifically to weather this. Now, every week I always give an update on my bias. My bias is, for the year, my bias is still to the upside. My bias is probably a 6 to 8 week period as we go into the second quarter for all of these things to work out as far as the market beginning to price in these changes.
It's certainly not unheard of for us to have a pullback of this magnitude and still end the year positive. That has happened before. That is not something that is out of the ordinary. But yeah, the volatility part of it is going to be interesting to watch. We are the other side of that coin is with the cash that we have on the sidelines, we will start. We talked a little bit, I don't know how many weeks ago, we talked about the model that we have that's like calendar trading, calendar effects model. Mm-hmm. So we will use the cash to make short-term trades. We're still going to be doing that. So there will be periods of times where a week or two we'll go into the market more, we'll have more exposure to it than we do now for very short periods of time, periods that are highly likely statistically and historically to produce returns during short periods of time. And it won't be very much, but it will be, I don't think there's any in April. I'll have to look at the calendar, but
yeah, calendar effects is a great, we rely on that as a default when a lot of when our momentum indicator for our more, our longer term outlook, and longer term is relative to the other indicators, which are very short term, which can produce a lot of noise. So you have to be able to read through that data because short term indicators it's just the nature of them. They can be very noisy. Whereas our momentum indicator is more of a longer term focused indicator that produces more actionable results with less noise. But as a result of it being a longer-term indicator, we fall back to calendar effects for opportunistic trading so that we can participate in statistically positive return timeframes.
Right.
So it's going to be very, very, very interesting. And the last time that this occurred, April of 2023, May of 2023, and October of 2023. I'm not looking at the actual dates.
Neither am I.
I am remembering. And then we know what came after that. Really, really great returns. Really,
yeah, I mean, if you
really
look
great
at
returns.
forward returns after something like this, they're generally there's a high likelihood that they are to the upside. Obviously, there's your black swans and your things that are out of your control. But if you look at when times like this have happened in the market previously, and you look 6, 8, 12 months later, you have positive returns. But that doesn't help you in the short term. And that's what the conversations we have with clients as well is, even though we are there giving, reassurances as best we can and talking about what we're looking at and what we're seeing and the action that we're taking, it's still not any less hard to take. It's a very difficult thing to understand, especially not understand. It's a very difficult thing to accept. To see your values go down, it has this. We talk about sentiment too. The sentiment has price dictates sentiment. Really, I mean that's what it comes down to. So in good times, you're happy. Bad times, you're not happy.
Yeah, I mean that's human nature. But you got to remind yourself that volatility is the price you have to pay for returns. If you want to have your money in the bank and make 3% and never keep up with inflation, or do you want to participate in the S&P and the Nasdaq and double your money over 10 years? That's or 7 years, depending how aggressive of an investor you are.
It's all long term for sure. Yeah. Because you look back, even the last 2 or 3 years, the majority of investors are going to be up, over that period of time.
Oh yeah.
Even with this. So the market doesn't go all the way up. It doesn't go up constantly. It doesn't go up in a straight line. There are things that come in and shake people out that maybe don't have the fortitude for it. But
and that's
keeps
good
right on rolling.
That's good for investors that are able to rebalance into that weakness. It's good for investors that, again, if you have a tactical allocation of cash in your portfolio, you can redeploy that at an appropriate time and get some really good upside. And it's for people that I guess that doesn't. I don't know if that's mine or yours, but I put do not disturb. So.
Well, I just muted. I don't know. Yeah, hopefully the microphone won't pick it up. But having calls, we're getting calls this morning.
We're getting calls. So all I'm saying is, if you're an investor that's in the accumulation phase, you should be salivating over moments like this.
Yeah.
Now, if you're an investor that's in your distribution phase, you should have an advisor that understands how to mitigate risk, that still positions you for growth, but allows there to be a cushion and a process, which is what we do. Yep. But if you're in the accumulation phase, you should be doing backflips over periods like this because it allows you to accumulate and to build wealth much quicker. And especially you don't want to be trying to time the market. If you're sitting on the sidelines trying to think when should you get in, when you should not get in, it's a very difficult thing to do.
Well, that's the power of dollar cost averaging. That's why our recommendation to people who are continuing to contribute to IRAs and 401ks is not going to shift. Don't stop doing that. Even if it's uncomfortable, even if you don't think there's a point to it, even if you get discouraged by the market going down, do not stop.
Yeah. And we do have clients that will have an account that's let's say it's not necessarily a retirement account. It's maybe for to purchase a piece of property, maybe to buy a new car in 6 or 7 years, and they will be a little more tactical with their savings in that when they see the market go down,
right?
We get a phone call, hey, let's add an additional 25, 50, 100K. We're not going to touch it for 3 or 4 years, but we think I'm very comfortable. This is a great time to go and start getting that money to work. And we're blessed to have. We work with over 200 families, and we're blessed to have clients that understand and appreciate that. But as a new investor or somebody that's never worked with an advisor, it is hard to do. It is a mentally hard thing to do, to see things that are going down and to still have that same motivation to continue to save. And so you're exactly right. Dollar cost averaging is a great way to turn off that emotional part of your brain. I'm going to invest $1,000 a month regardless in my 401k. It doesn't matter. And again, when you see these periods of drop, it shouldn't make you sad. It should make you happy because now you're getting NVIDIA, at half of what your neighbor next door was getting it last year for.
Yeah. Well, investor psychology is very interesting. I mean, the whole there's a whole realm of study of behavioral finance. It's very interesting because you can have the same concept, which is that the value of something goes down. And in one aspect of the economy, namely goods and services, that generally increases the likelihood or the chance that people are going to flock to that product or service. If you see something on sale at the store and you even remotely are interested in it, there's something that you've been looking at and it dropped down to $5 or it's got a yellow clearance sticker on it, you're going to pick that item up. You're going to say, hey, throw this in my cart. The opposite side of that, when the market is doing that, that's not the first thing we run to. Sometimes it is. Sometimes it is with certain people, but it's a difficult thing, and that's a very simplistic example. Again, I know it's not going into the in-depths of all the economic relationships and every effect, but just saying that sales in one area promote buying, sales in other areas cause concern. Understandably, I mean, I get it, I understand it, but yes, don't stop. That's what we would say. If you're buying into it, if you're on the younger side of the spectrum, even 30s, 40s, if you're still 15 years away from retirement, buy something.
Yeah.
That's just the name of the game. I mean, this is how you build wealth over long terms. Just keep in mind that it's long term, and then go back, look at your portfolio. Click that, instead of clicking on that year-to-date option, click on the 1-year option, click on the 2-year option. Get a little bit of a boost there. Yeah, I'm up. I'm up
30% over 3 years.
We've had really good years the past few years.
Yeah.
So, is this concerning? Yeah. But are we going to get through it?
Yeah.
Of course.
Yeah, absolutely. And those of you that take advantage of it, remain disciplined, stay invested, have conversations with your advisor. And if you're not working with an advisor, find one that you can trust, momentumwealth.us, and get in the game. I learned a long time ago that the reason the rich get richer and the poor get poorer is very simple. It doesn't have anything to do with household budgets. It doesn't have anything to do with necessarily how much money you make, although obviously if you make more money, it's easier. But it has to do with whether or not you take your dollars that you've gotten in exchanging of your time at your workplace and taking those dollars and either putting them in something that goes up in value or something that goes down in value. You want to own assets. And we're very fortunate enough to be on this earth at the time that we're on it, because getting access to assets is easier than ever. Finance has become so democratized that there is no barrier to entry. You can do it with you can do it with your tip money from your night job while you're going to school. You can. It is so easy to get access. So you want to be focusing on buying assets and not on buying things that go down in value. And I will add one more thing to that. When you're looking at your stock portfolio or your 401k and it's down, think about it like your house. If you know that over the next 10 years, the house that you bought, the area you live in, the school zone, the neighborhood is going to be worth more in 10 years than it is today, you wouldn't immediately sell it tomorrow if the price went down 5% or 10%. You say, no, I'm not selling. So, that's the same way you have to look at the stock market, because what a lot of people will do is somebody will come along and say, hey, I'll buy your S&P 500 from you at 10% less today than it was tomorrow. And that's all the price you're seeing on the screen is. That's what the next person's willing to pay. And a lot of people look at that and say, oh, I have to sell. I have to sell because this other person thinks it's less. But you don't do that with your house. You say, no, piss off. I'm not selling. I paid $400,000 for this house. I'm not selling to you for $360. You're kidding me? I'll sell it in 7 or 8 years for $600 or $550. So if we shift your mindset more toward the asset side of your balance sheet and you don't let short-term price fluctuations throw you off your game, you are going to be successful. You absolutely are going to be successful in your life.
Yeah, hear. A second. Raise a toast.
Should we do 3 points in an altar call?
Yeah. Yeah. Well, that's how we look at it here. Of course, this is very 30,000 foot view. This is not in-depth deep dive into exact fundamentals and methodologies of what we do. This is a very concise, simplified version of it. We do have some things to keep an eye on in the next week. CPI is going to come in on Wednesday. That should give us some indication on.
That's our March numbers. Do we have any consensus as to what investors think that's going to be yet?
I don't know. That's a good question. I mean, I would assume that it's changed now. We've got jobless claims on Thursday, and then the sentiment Michigan study on Friday. So The Fed is going to enter a blackout period ahead of the next meeting. So we're not going to hear anything from them this week, which is particularly interesting because of the week that it might be. I mean, the volatility is going to be the theme. I would stand by that. I said that last week too, and I feel like I'm constantly talking about it, but it's just because it's there. It's the theme of, hopefully not the quarter, but it's the theme of certainly the next few weeks, I think, is volatility, which doesn't necessarily have to be a bad thing. It just is what it is. It's something that you have to learn to live with, and you have to take advantage of in the areas that you can take advantage of it in.
Yes, and we'll be giving updates on how we, it won't be in real time. It will be delayed a little bit because, again, the nature of our podcast is for informational purposes, not for acting advice. But we will be giving updates on how we deploy the tactical portion of our portfolio, how we deploy the cash, what sectors we're looking at that we think can provide the potential for outsized gains relative to the indexes. And so we're very excited to bring that information to you. Not in real time. There will be a slight delay, but relatively speaking, as we act those out and act on that data, we'll bring that information to the podcast and share it with the public.
Yeah, I mean, it's there's a lot of opportunity out there. You need to have somebody most likely to walk beside you and help you seek out that opportunity. A lot of time advisors are really, you find out how much advisors are worth in the bad times. And then, that's just how it goes. But there's sort of a barrier there if you've never worked with it. Like you said, it can be a little bit of a shift, but that's what they're there for. That's what advisors should be there for, to give clear communication, to tell you exactly what they're thinking, what they're looking at, what actions they're taking. We're not doing this. We're not reacting. We prefer to think of it as responding. So we're going to set ourselves up to take advantage of weakness in the future that we think is going to potentially continue to come. It's 10 something here. No, 11. Market's still down. Actually, we're kind of improving a little bit. S&P flat. So it'll be interesting to see what happens the rest of the day. But I think this is in the news of how it could have gone based on futures. I think this is positive. There were NASDAQ or Russell 2000 futures, I think, were halted overnight because they hit their downside limit. A lot of people were expecting we're going to see these indexes hit their limit at the open. Obviously, we didn't see that.
Nope, didn't happen.
So there is some positivity. I haven't looked at the news.
A lot of
maybe
buying,
there
buying
is
coming in.
Yeah, maybe there is some more news on the tariff front. Maybe they've announced some more countries are coming to the table. I don't know, but just keep an eye on it. That's what I would say. Volatility is going to be here. If you can't stomach that, I would just say don't look at your account. Whatever you have.
Stomach the volatility, but I will
as long as you have someone watching it for you.
Correct.
You can't just shirk it if you're doing it on your own. I wouldn't recommend that.
And I see over the years, I have seen that these time periods are in my opinion, the absolute best time for, if you've been sitting on an old IRA, if you have an old 401k from a workplace, these times, because that's really when your attention can be drawn to how they're allocated.
Yep.
And it may have been an allocation set years ago that's no longer appropriate for you or your risk tolerance. These are great times to pick up the phone, give us a call, go to momentumwealth.us. Let us have a second look. Doesn't mean you have to do business with us, but we'll be more than happy to provide you a second look, a second opinion. And these periods of volatility, they're great opportunities to clean up these IRAs that you got sitting around town, these old 401ks, get some eyes on it. And depending on how you're allocated, you could very well take advantage of this market weakness to get some easy gains by getting the right type of allocation when the recovery comes. So, I would definitely encourage old retirement accounts, old 401ks. This time period is the best to take a look at it, to be emotionally activated, to clean this up, to get some eyes on it, to not just set it and forget it. And we'd be more than happy to be a part of that process for you. So that's all I have for today.
Yep. That's all I have as well. We'll be back next week to talk more about, CPI print. Maybe we'll have some Federal Reserve announcements, or somebody will talk next week. We'll kind of see how that sort of progresses. Maybe we'll have some updates with the tariffs, updates with fundamentals of the market, that sort of thing. But,
And watch crypto. This month, our methodology with crypto is very closely held, but I will say this month is, I'm highly confident this is a month to watch for what happens with Bitcoin in particular. This month of April, maybe the next first 2 weeks of May. And so may have some interesting and some exciting price action in the crypto markets. So we'll see. We'll see if my prediction on that comes true.
Yeah. I mean, predictions are hard. That's what I would say.
Oh, they're definitely there.
Our bottom line is, we don't control markets. We can control how we respond to those markets.
What do these buttons do?
They don't control the markets.
They don't control the markets?
No. We don't chase trends. We don't react emotionally. We are very rules-based. And so when we see data that tells us to do something, we do that thing. And so, if you don't have something like that, if you're struggling.
And a lot of times that data will contradict our own personal opinions.
Right.
Which is
a lot of the times.
Yes, and we have to set those personal opinions aside.
Right.
And follow the data. And that's what makes a good money manager, a good advisor, is being able to separate those two things. Because a lot of them can't. You'll have an opinion, you get pigeonholed into it, and it doesn't matter what the data says. They could slap you in the face with data all day long. You will not change your mind. And that is not good for clients. So you 100% right. You want to have a disciplined, rules-based, data-driven approach.
Amen. Well, that wraps it up. I hope the rest of the week is very good for everyone. I hope, we have some positive momentum in the market this week. Here's to that, knock on wood. Anyway, we'll see you back here next week. Feel free to like, subscribe, share this video if you liked it. If you want to, start a conversation or anything like that, reach out to us. But we'll see you guys next week.
Yeah, take care. Peace.